Hey everyone, today I'm going to cover our final financial statement, which is the statement of cash flows. This tends to be prepared towards the end of your introductory financial accounting course. So we kind of wrap it up with the statement of cash flows because you really need to understand how the accounts behave and the theory of financial accounting before you can get into the statement of cash flows. So we probably covered the statement of cash flows in theory, or you probably did in your financial accounting course early on, but you didn't get into the details, the nitty-gritty of actually preparing it. So what I'm going to cover in this particular problem is just the operating section of the statement of cash flows. So your statement of cash flows is made up of three different sections: your operating section, your investing section, and your financing section. The investing section and the financing section does not differ between if you use the indirect method versus the direct method of the statement of cash flows. A majority of companies, about 90% of companies, use the indirect method, and that only varies again on the operating section, which is I'm going to cover in this particular problem. So go over a problem so you can see how all of the statement of cash flows is prepared. So cover that section in your chapter. So I'm just going to get into the operating section because that tends to be the hardest for students. And again, I typically only cover the indirect method in an introductory accounting course because again, it's prepared by most companies. So I don't really get into the direct method too much. I just want them to be aware that there is two different types of methods. But if your particular instructor wants you to cover the direct method, make sure to cover that type of problem so you know how to prepare it. All right, so let's look at this problem. Our cash flows from or used for, depending on whether it's an inflow or an outflow, are operating activities for the indirect method. So it gives you your data here, and it gives you your changes in the accounts because we need these accounts from our balance sheet to know if there's money coming in, cash coming in versus cash going out. So we're only concerned with cash flows on the statement of cash flows. So in accounting, we like to take things very literal. So prepare the cash flows from or used for the operating activity section of the statement of cash flows using the indirect method. All right, so I went ahead and set up a chart here, so which is what you're going to want to do when you prepare the operating section of the statement of cash flows. So make sure you know the format of how to prepare it. So I went ahead and did this for ease of use, so I don't have to be typing in, and I can explain as we go along. So the first thing you always want to start with under the indirect method is the net income, because you're adjusting net income for changes in your current assets and your current liabilities. All right, so our net income in this case is $236,400. All right. Then we want to do any adjustments to reconcile net income to net cash flows used from or used for operating activities. Depreciation is an expense that's showing up in your income statement. But if you remember from your long-term liabilities chapter, depreciation is not an actual cash flow. You're not actually sending out cash for depreciation. You're not making a depreciation payment. It's just a way to recoup the initial cost of an asset, which doing that shows up in your investing section of the statement of cash flows. So if you had your net income still including your depreciation as an outflow of cash, you'd be double counting it when it comes to the investing section. So we need to back that back out. So we need to add back our depreciation. So depreciation for this year was $70,700, essentially taking it back out of your calculation for your net income. I'm bad at typing today. All right. Then we need to go ahead and count for any changes in our current operating assets and liabilities. So we have our list of our current assets and liabilities for the year. We have our end of the year amounts and our beginning of the year amounts. So what we're going to do is we're going to take the difference between these two columns. So let me talk a little bit about a theory behind why we do what we do in this section. All right. So the difference between memorization and understanding takes time. So what I always tell my students in this chapter is try to memorize it first and then get to that understanding point. Understanding will come possibly after memorization. If you get it right away with the understanding, that's fantastic. But not most students don't. They tend to memorize first and then the understanding. You'll just have this one day, it will just click. And that's fantastic. When I was a student, I did the memorization first and then I understood it later on. It did eventually come. So I just want you to know that if it's not coming right away, it's okay to memorize at first. I would love for you to get to that understanding initially, but that's not always possible. So I'll take what I can get at this stage because hopefully understanding will come. All right. So I already have in here that we decreased our accounts receivable and we increased our inventory. So what you want to do is look at the changes in your current assets and your current liabilities. So not accounting for cash because this will be accounted for in the end. But you're essentially accounts receivable, inventories, prepaid expenses, accounts payable, and salaries payable are our current assets and liabilities here that we're going to account for in the operating section. So what I mean is it decreased. So at the end of the year, it was $149,530, but at the beginning of the, oops, sorry, I'm in the inventory, sorry. Accounts receivable, $75,840, but at the beginning of the year, it was $77,500. So we started at $77,500, we went down to $75,840. That's great. It means people are paying us more money, right? We have more cash coming in. So we have more cash coming in that has a positive effect on our cash flows. So when I want to do my calculations here, since it had a decrease, so we have a decrease in accounts receivable, but it has a positive effect on our cash flows. So I want to do the opposite when I make my calculation here, and that's confusing to you right now. Again, memorization gets to understanding. So anytime you have a decrease in a current asset, it has the opposite effect on your cash flows. So I always say assets opposite, liabilities same. What that means is if I have a decrease in an accounts receivable, which is a current asset, it has the opposite effect on my cash flows. So it increases my cash flows. If I have a decrease in liabilities though, however, it is the same and it does decrease my cash flows. So when I go to do my calculation, assets opposite, so put a negative in front. And then take your end of the year. One second, I need to mute that. So take your end of the year and subtract out the beginning of the year. So take the difference between the two columns. I have a decrease in accounts receivable, but it has a positive effect on my cash flows. Essentially, my accounts receivable went down, which means more people are paying me money, which has a positive effect on the cash flows. All right. I have an increase, however, in my inventories, though, which has a negative effect on my cash flows. We had inventories of 133, but now we have inventories of 149, which means I paid out more money for my inventories. I'm not selling as much, essentially. So I have more inventory, which has a negative effect on my cash flows. So assets opposite, again, so put that negative in front before you do your subtracting end of the year from the beginning of the year. Oops. Yeah, we'll go ahead and do that. So an increase in an asset has a negative effect on my cash flows. My inventories went up, which means I'm paying out more money. All right. We also have a decrease in our prepaid expenses. So our prepaid expenses went from 8850 to 8310. So, which means we're paying out more money. Paying out less money. Sorry. Paying out less money. Hopefully I haven't confused you more. So we're paying out less money. So we have a decrease in our prepaid expenses. So the amount we're paying out in advance of payments due has gone down, which has a positive effect on our cash flows. So again, assets opposite. So go ahead and put that negative in there before we do our beginning of the year subtraction from the end of the year. I keep forgetting to put my parentheses in there, but it's correcting it for me. All right. So that has a positive effect on my cash flows. Again, I'm paying out less money. So that's a positive effect on my cash flows. All right. Now we're down to liabilities. We have accounts payable and salaries payable. Again, liabilities have the same effect. So not the opposite effect that the assets have. That's merely a memorization tool. Assets opposite, liabilities the same. So anytime there's going to be a decrease in a liability, it's going to have a negative effect on the cash flows. Anytime there's an increase in a liability, it has a positive effect on the cash flows. You can hear my dogs decided to play in the middle of my recording. So, oh, now they're giving me a face. All right. Decrease in our accounts payable. So beginning of the year, it went from 70,000 down to 66,000. Means we are paying back more money than we originally were. So we had a 70,000 balance. We now only have a 66,000 balance, so we're paying out more money, which has a negative effect on our cash flows. So I don't need to put that negative in front because it's not an asset anymore and it's behaving the same way. So take your end of the year, subtract out the beginning of the year. And our liabilities went down by 3270, which has a negative effect on the cash flows. All right, and then go take your difference between the end of the year and the beginning of the year. For our liabilities, we have an increase in salaries payable from the beginning of the year to the end of the year, which means we have paid out less money here. So we've paid out less money from the beginning of the year to the end of the year, which has a positive effect on the cash flows, which means anytime you're not paying out money, you have more money sitting in your bank account. All right, so the net cash flows from operating activities is taking a sum of your columns here. So let's just do equals sum. Sum up our columns here. I'll put my parentheses in there so it doesn't give me that error message anymore. And our net cash flows from operating activities is $299.10, essentially just a sum of this. So we're taking our net income, adding back any depreciation and amortization. In this case, they had depreciation because it is not an actual cash outflow, so we still have cash. And then taking into account our changes in our current assets and current liabilities. Okay, I hope that made our statement of cash flows problem a little more clear for you. Again, it just takes some practice with this. Start with the memorization and then get to the understanding of why we adjust for our changes in our current assets and liabilities, and how that has the effect on our overall cash flows. Essentially, at the end of your statement of cash flows, after your investing and your financing sections are prepared, should be the difference between your end of the year and your beginning of the year cash balance. So it's a way to check yourself at the end. That's why I had this cash still on here, because our statement of cash flows, we started with $62,800 in cash. We ended with $59,810. Why is there a difference between this? And that's what your statement of cash flows helps you understand, is where the cash went. Why is there about $3,000 less in cash than we had last year? So statement of cash flows gives you a detailed list of why. Essentially, it's why there is a difference between the beginning of the year and the end of the year cash. Okay, so if you like this video, go ahead and click like and comment below if you'd like to see any additional videos, and subscribe to our channel so that you can stay up to date on any changes that we have going on in accounting, and any, like I said, I'll try to add some tax videos, some more cost accounting videos. I'm going to get into some managerial accounting shortly, so an introductory managerial accounting course, so that you can stay up to date on that. So in the meantime, happy studying.